You go to work. You get paid. Before that money ever reaches your bank account, a portion of it has already been taken. Federal income tax, state income tax, Social Security, Medicare. By the time your paycheck lands, you might be keeping 60, 65, maybe 70 cents of every dollar you earned. This is not a complaint. It is just a fact of how employment income works in most countries. You earn money, you pay taxes on that money, and the rate scales with how much you earn. Now consider Elon Musk. In 2021, a bombshell investigation by ProPublica revealed that between 2014 and 2018, Elon Musk paid $0 in federal income tax. Not a reduced rate. Not a loophole that saved him a few $1,000s. Zero. The wealthiest person on Earth, by many measures, paid nothing. And in the years he did pay, his true tax rate, calculated against his actual increase in wealth, was a fraction of what most middle-class workers pay on their salaries. How is this possible? And more importantly, is it legal? The answer to the second question is yes. Completely, entirely, frustratingly legal. And understanding why requires understanding a distinction that sits at the heart of the modern tax system and that most people are never taught in school. The distinction is between income and wealth. When you go to work and your employer pays you, that is income. It is taxed immediately, at the moment it arrives, at rates that in the United States can reach 37% for high earners. But wealth is different. Wealth is the value of the things you own. And in most tax systems, including the American one, you do not pay taxes on the value of things you own. You only pay taxes on things you sell. This is called the unrealized gains problem, and it is the single most important concept for understanding why billionaires pay lower effective tax rates than nurses and teachers. Here is how it works in practice. Elon Musk owns a very large percentage of Tesla. When Tesla's stock price goes up, Musk's wealth increases by billions of dollars in a single day. On a good week, he might become $10 or $20 billion richer. But he has not sold any stock. He has not received any payment. The wealth exists, but it exists as an unrealized gain. And because it is unrealized, it is not income. And because it is not income, it is not taxed. You cannot pay your rent with unrealized gains, but you can borrow against them. This is where the strategy known as buy, borrow, die becomes one of the most powerful wealth preservation tools in the history of personal finance. And economist Edward Wolf at New York University has documented extensively how this strategy, combined with favorable tax treatment of capital assets, has contributed significantly to wealth concentration among the top 1% over the last 4 decades. Here is how it works. Step 1. You accumulate assets that appreciate in value. Stock, real estate, art, private company equity. Step 2. Instead of selling those assets and paying capital gains tax, you borrow money from a bank using those assets as collateral. Banks are very happy to lend money to billionaires at low interest rates because the collateral is extremely reliable. Step 3. You use the borrowed money to fund your lifestyle. Buying houses, yachts, funding rockets, whatever the cost of living looks like at your income level. Step 4. You never sell the assets. You simply take out new loans to pay off old loans. Or you die. And this is where the die part of buy, borrow, die becomes crucial. Under current United States tax law, when you die and pass assets to your heirs, those assets receive something called a step-up in basis. This means that the unrealized gains that accumulated over your entire lifetime are essentially wiped clean for tax purposes. Your heirs inherit the assets at their current market value, not the value when you bought them. The tax on decades of appreciation simply disappears. So the complete life cycle looks like this. You buy Tesla stock at $1 per share. It goes to $300 per share. You borrow against it. You live off the loans. You die. Your children inherit the stock at $300 per share. The $299 per share of gain that accumulated over your lifetime is never taxed. Not once. Meanwhile, back in the real world, a teacher earns a salary, pays income tax on it immediately, invests what is left over in a retirement account, and when she eventually sells those investments, pays capital gains tax on the gains. Every step of wealth accumulation is taxed. Every step. But wait, there is a second layer to this. Even when billionaires do sell assets and pay capital gains tax, the rate they pay is lower than the rate a high-income salaried worker pays on ordinary income. In the United States, long-term capital gains, meaning profits on assets held for more than 1 year, are taxed at a maximum federal rate of 20%. Ordinary income, meaning your salary, is taxed at a maximum federal rate of 37%. This means that a hedge fund manager who earns $10 million by selling stock pays tax at a maximum rate of 20%. An employee who earns $300,000 in salary pays at a maximum rate of 37%. The person with more money pays a lower rate. This is not accidental. The preferential treatment of capital gains was explicitly designed to encourage investment. But its effect has been to create a two-tier tax system where people who earn money from working pay more than people who earn money from owning things. Economist Emmanuel Saez at the University of California, Berkeley, has spent decades studying effective tax rates across income levels, and his research shows something remarkable. When you account for all taxes, federal, state, and local, the effective tax rate for the very wealthiest Americans is often lower than the effective rate for middle-class workers. The tax system, in practice, is not progressive all the way up. It becomes regressive at the very top. And then there is the carried interest loophole, which is the most controversial piece of tax policy in America that most people have never heard of. Private equity managers and hedge fund managers are paid, in part, through something called carried interest. This is their share of the profits from the investments they manage. Under current law, carried interest is classified as capital gains rather than ordinary income, even though it is clearly compensation for work performed. This means that a private equity manager who earns tens of millions of dollars in carried interest pays capital gains tax rates of 20% rather than income tax rates of 37%. For decades, politicians across party lines have promised to close this loophole. It has survived every attempt because the private equity industry spends heavily on lobbying, and because the managers who benefit from it are among the largest donors in American politics. Economist and former Secretary of Labor Robert Reich has argued that the survival of the carried interest loophole is the clearest possible evidence of what he calls the vicious cycle of inequality. Wealth buys political influence preserves the tax structures that generate wealth, and the cycle continues. So what does any of this mean for you? Understanding this system does not mean you agree with it or disagree with it. Tax policy is genuinely contested, and serious economists disagree about the right approach to taxing capital. Some argue that lower capital gains rates encourage productive investment that benefits everyone. Others argue that the preferential treatment of capital income has become the primary driver of wealth concentration and inequality. The evidence for the second argument, as documented by Thomas Piketty in his research on capital in the 21st century, is substantial. What it does mean is this: the intuition most people have, that higher earners pay higher rates, is only true up to a certain point. Above that point, the relationship reverses. The tax code, as written, treats a dollar earned from working differently than a dollar earned from owning. And the higher the wealth level, the more of your income comes from owning rather than working, and the lower your effective tax rate tends to be. The next time you look at your paycheck and see how much was withheld before you ever touched it, you are not looking at a universal law of how money works. You are looking at a set of political choices made over decades about whose economic activity deserves to be taxed, at what rate, and when. Those choices can be changed. They have been changed before. The question is always who has the most incentive to change them and who has the most power to stop that from happening. Elon Musk did not invent this system. He is using it exactly as it was designed to be used. The more interesting question is why it was designed this way, and whether it still serves the purpose it was supposed to serve. That question does not have a simple answer, but it starts with understanding the rules. And now you do.